Now let's look at the way crypto trading works. The traders are essentially the same, except that they're indistinguishable. So when you have the traditional world, different traders usually have different roles. They have different opportunities and possibilities and options that the broker affords them. In the blockchain world, there may be some differences, but it's much harder to differentiate. Um, so now next thing is where does the trading actually occurs in the crypto world? Well, first of all, there are also exchanges. Here's a few listed here: Kraken, Quadriga, CoinSquare, Polyonics. Polyonics is probably the biggest at the moment. Kraken is also very big. So those are centralized venues that offer limit order books very much in the same way as exchanges such as the Nasdaq or NYSE offer. Obviously, this is a newer world, so they do different things. There are also dark pools, or rather, they're dark pools in preparation. So, for instance, there's the so-called Republic Protocol, where they try to do dark trading. And finally, and this is actually one thing that is very different and pretty exciting about blockchain-based trading, is that there's the possibility to trade and do the entire interaction on-chain with smart contracts. There is information aggregators for those interactions. One example there is EtherDelta. Now, how does the trading actually work? Well, if you have exchanges, it's quite straightforward. You have an account with the exchange. You do then order driven trading, means you post limit orders, and if a buy order has a higher price than a sell order, then you will have a transaction happening, and that's all. There are also markets that have a designated market maker where all trades go through a market maker. One example is Lique. Now, one of these things to note about these different exchanges is they also choose which securities or which tokens to trade. So you can't trade every token in every market, just to be very clear. It's particularly important for market maker markets because they have to have the ability to hedge their activities. Market making is an expensive activity. Now, the part about the smart contract based trading that I mentioned earlier, this is the exciting part about it, where basically all that you do is you write a smart contract, and you register it on the Ethereum blockchain. And then outside parties can essentially just access that contract by sending funds to that contract. And then the contract will facilitate the exchange. And the entire interaction happens in a decentralized or distributed manner on the blockchain. There's no central entity, no central authority, nothing of the kind of a place where something happens. All right. So how do you access the markets? Well, the standard way, if you want to go through one of these exchanges, the way to do it is you have to go to the blockchain. You have to transfer your funds to the exchange. So it means you take your address and send it to an exchange address, which the exchange gives you. It's usually there's a reference number and the like, so that the exchange knows where the money ought to go. And then from there, you do the trading within the exchange operation. If you, of course, use an on-chain smart contracts, all that you do is you send money to a contract that you have created yourself. Now, how do you trade within the exchange? Say, if you take Polyonics, there's interesting options that are open to you there. So you can do your trading by putting market orders in. But also the funds that you keep in the venue, you can use for lending them out to other parties. And you can then borrow these funds if you want to do margin trading or to do short selling. So in other words, when you lend out your funds at the exchange level to other parties, you can collect fees from that. The downside is if the venue would be hacked, then you stand to lose your money. That happened, for instance, with Mt. Gox a few years ago, where a very large amount of Bitcoins was stolen. All right. Now, how does the settlement work? With Bitcoin and Ethereum, it's quite simple. So if you say go with the exchange operation, you send your Bitcoins to the exchange, you do your trading at the exchange, and then you basically, whenever you're ready, you take your funds out of the exchange wallet and put it back onto the blockchain. Of course, if you trade on the blockchain directly with smart contracts, then settlement and all of that is intrinsic to the smart contract that you wrote. So you basically, the trade itself becomes the settlement. This fully decentralized version is something that requires a little bit of understanding, especially people who have never really dealt with who have, let's say, entrenched in the current market. They don't fully understand this. This mask EtherDelta, what they essentially do is they provide you with the smart contract code that you need. and then they scan for the smart contract code on the Ethereum blockchain using a standard blockchain explorer. And all that they do is essentially they record the existing contracts in an order book, and then allow you to interact with that with their own interface, where you can basically use, an order entry here. If you want to look at it here, this is the order entry where you can enter information, where you can enter an order, and it would then be either recorded on the blockchain, or you can interact with an existing contract. And the contract code you can actually find up here by just clicking on this. And if you think about this essentially replaces the functionality of an exchange with about 300 lines of code. That's a pretty big accomplishment. And if I would be an exchange, I would be pretty scared because, an exchange does many, many things, and it's a very complex operation. But the core business of matching buyers and sellers, in particular for very illiquid securities, that can be done much easier with this decentralized methods. Now, to summarize, if you just summarize that workflow, if in the traditional markets, what you do is an investor goes to a broker, sends instructions to the broker then accesses the various different markets, often at his or her own discretion. It can go to an exchange, a wholesaler, dark pool, internalizer. And then the venues, once a trade has occurred, access the settlement system, which involves the DTCC, say in the US, the Federal Reserve for if there's any cash transfers, Broadridge is if there are changes in beneficial ownership that need to be recorded, and custodian banks. In a blockchain, in the crypto world, the investor makes a call which venue to access. So say they send money from the Ethereum blockchain to Polyonics. They do their trades on Polyonics, and then the settlement occurs by taking the money again from the venue, taking it out and registering again the funds to the blockchain. The alternative is you can do everything on chain, where you create a smart contract, and the trade essentially, when the trade happens, is synonymous with the settlement. As you can see, so the main differences, if you want, in a structural way, not just in terms of the workflow, is that equity markets are highly regulated. They have firm trading rules. They have listing requirements. Now, you can make a case that it may also occur for some blockchain based or crypto venues, but in general, there's very firm listing requirements. There's regular reporting is necessary for this. But it is a cumbersome multi-step process with potential conflicts of interest between many different parties. And a lot of the regulation is based on the fact that we have brokers that take decisions on your part, that we have exchanges that interact with brokers and create, with fee structures and other things, conflicts of interest. And you have a very complicated settlement system, which essentially has been the same for 50 years or so. And there are many, many intermediaries. As NASDAQ estimated in an equity trade, there can be up to 30 intermediaries between two parties wanting to trade. Now, that's a market which creates a lot of friction, which requires regulation, and it is very cumbersome. The crypto market, on the other hand, is entirely unregulated. Some people may think that's a good thing. That it's also a bad thing because it comes with no trading rules. And I think the assumption has to be that manipulation occurs. So, for instance, I can go out and I can create my own token and trade it with myself many times over to pretend that there is a lot of trading volume and to pretend that it's high value and try to lure people into it. Is that allowed? Well, it's not allowed in securities trading. And I'm not saying that I'm doing any of this, but it's a possibility. Can you prove that's not the case? Well, it's really hard to do because I can create as many addresses and do these trades as many times as I want. However, trading in crypto markets is a very simple process. It can be as much as a single step process if I use smart contracts that are registered on chains. Whether I want to use intermediary is a choice, and one should always think of these crypto exchanges that as they're much closer to current brokerages than to equity exchanges. Equity exchanges, in some sense, are just utilities that facilitate transactions. Crypto exchanges, they actually take deposits from people. Now, you have choices of how to move your money in and out of the system, but you have to be aware that there could be shortages, technical problems, and so on that nobody will help you with. Settlement here is a choice. So taking money in and out of these crypto exchanges you can do, and at that point, once it's registered on the blockchain, it's yours. And this is the most critical and exciting part about it. Fully decentralized trading is possible. So you can actually fully disintermediate this market, which has been around for hundreds of years.